Hello students, let's begin with the new concept, that is the financial institutions. First industrial policy was declared in the year 1948 for the rapid industrial development in our country. So after India becomes independence, the priority given by the government at that time was to have an industrial growth and development, and in that particular way the government of India have formed a policy in the year 1948. The central and the state government have established a special financial institution for providing the finance to the industrial sector, especially at the state level and normally at the central level. These institutions provide the medium term and the long term finance for the growth and development of the industries in India. The assistance of these institutions have become an important for the new company as well as for the going concern. And here you can see on page number 28, you can see the financial institutions in India. The chart has been given. The financial institution is being divided into four subtypes. The first one is a developmental bank. The second one is a financial institution. Third one is an investment institution, and fourth one is a state level institution. Let us see the first one, that is the developmental bank. Developmental banks are those banks which have been set up mainly to provide the infrastructural facilities for the industrial growth of our country. So development banks are those banks which help the industries and the companies for providing an infrastructure facility. They also provide the financial assistance to both private as well as public sector industries. They provide the medium term and the long term finance for the industries. They do term lending, investment in securities, and the other activities that is necessary and essential in the growth and development of that particular industries. They even promote the saving and investment habits among the people in the industries, among the people in that particular industry. And there are different types of industrial banks have been given here. The first one is an IDBI, you can see Industrial Development Bank of India. Next one is an IFCI, Industrial Finance Corporation of India Limited. Third one is an ICICI, that is Industrial Credit and Investment Corporation of India. Fourth one SIDBI, Small Industries Development Bank of India. Fifth one Industrial Reconstruction Bank of India, that is IRBI. So here the five institutions have been set up at the national level and two at the state level, so that the majority of infrastructure facilities is being provided to the industrial growth and development of a country. Let us see the second one, that is a financial institution. A financial institution is a company that is engaged in the business of dealing with the financial and monetary transactions such as the deposits, loan, investment and currency exchange. So these financial institutions helps the industries in having a monetary and financial dealing among the certain transactions like deposits, investments, loan and the currency exchange. And the different financial institutions which has been set up here are three. First one is the Risk Capital and Technology Finance Corporation of India. This provides the investment related to the industries among the capital and the technological financials. Second one is the Technology Development and Information Company of India Limited, that is TDICI. And the third one is the Tourism Finance Corporation of India, TFCI. Let us see the third one, that is the investment institution. And institutional investor is an entity in which pools the money to purchase the securities, real property and other kind of investment in the assets and originate in terms of loan. So these are an institution which is set up in order to provide an investment in the company, so that the majority of capital can be given in that industries for its smooth functioning and operation. And in example of this investment institutions are LIC, that is the Life Insurance Corporation of India. Second one is the Unit Trust of India, that is UTI. Third one is the GIC, which is known as the General Insurance Corporation of India. And I hope that you all are familiar with these three concepts, LIC, GIC and UTI. The LIC, GIC, UTI, what these companies will do? This is a financial institution. They provide the safety and security to the investor against the life and the property, and the amount that they get in the form of premium, they mobilize that amount to the different companies in order to provide the smooth functioning and operation of the industries. Let us see the fourth one, that is the state level institution. Now this state level institution, they act as a catalyst for the promotion of investment and industrial development in the respective states. So this is the institution which has been set up at each and every state wise, and accordingly they will fulfill the need and the requirement of the industries at various states level. They broadly consist of the State Financial Corporation of India, that is SFC, and State Industrial Development, that is SIDC. So these are the two examples which has been given. These are the two institutions which is related to the state level institution. That is first one, that is the State Finance Corporation, and second one is the State Industrial Development Corporation. They both provide the support, they both provide the help for the industries to set up at the state level, and also promote the smooth functioning of its business in the state level. The above mentioned institution provide financial assistance in the following form. The first one, they provide the term lending facility, that is for the they provide the amount capital for the medium term as well as the long term in nature. They also subscribe the shares and debentures of the company. I have discussed in our earlier videos related to the subscription of shares and debentures. The third one, they also underwrite the issues of security. The newly formed company, they wanted to have the minimum capital requirement for the operation of its business. So these companies, like we can say investment institutions, they act as an underwriter. They purchase the unsold shares of the company and give the warranty and guarantee that they can provide the required amount of funds so that they can start their business operations. Fourth one, they lend the money. The industrial institution, they can borrow the money for its various business purposes like expansion of business, diversification of business, and many other industrial activities. And the fifth one is they guarantee the term loan raised by the company. So they also provide the term loan for its various business contracts and dealings, and accordingly they provide the finance to the industrial institutions. So these are the financial institutions which has been set up at the national and the state level, and accordingly they provide the funds so that the smooth functioning of the industries and business houses will take place, and they can equally contribute in the industrial growth and development of a country. So here we have completed the concept of financial institution. Let us see the next concept, that is called trade credit. No business can run without credit. So we can say credit is one of the important tool in each and every kind of business organization, irrespective of the form of business, that is from the sole trading concern till the joint stock company. Each and every form of business organization, they need to provide the credit facility so that anyone can ensure the smooth functioning of a business can takes place. Credit is the soul of the business, that is one of the most important part of any business activity. Trade credit financing is a major source of short-term financing. So trade credit is provided in order to have the short-term finance. Manufacturers, wholesalers, and the suppliers of goods or material are called as a trade creditor. So the manufacturer who manufacture the goods, they will distribute after manufacturing a good, they sold it to the wholesaler. The wholesaler, they supply the goods and services to the supplier, and the supplier retailer, that supplier or the retailer, and the retailer will directly sold out to the customer in the market. They all will provide some or the other form of credit so that they can have the minimum capital requirement, and accordingly they can carry out the business in a proper and the smoother manner. They sell the tangible goods to the other business concern on the basis of deferred payment, that is, payment should be made in the future. For example, if the manufacturer manufacture the goods, and if he sells certain amount of goods to the wholesaler, then the wholesaler will not going to make the payment of all the amount that he have purchased from the manufacturer. For example, if the manufacturer sold the goods of rupees 1 lakh to the wholesaler, then the wholesaler will give only 50,000 rupee, and rest of the 50,000 he will give it after the 30 days when when he sold out certain amount of goods to the ultimate consumer in the market. So manufacturer will give 30 days credit period, that is 30 days time, so that he could sell some of the commodities and then he could make the payment to the manufacturer, and accordingly such situations will prevail further if the goods went to the retailer and ultimately the consumers in the market. So they sell tangible goods to the other business concern on the basis of deferred payment, that is on the basis of future payment, that is when credit is extended by the business concern with an intention to increase their sales. So if they don't provide the credit, then the person will not going to associate with that business houses, because they do the business purely on cash transaction, purely on money basis. So if credit is not been provided, then the people will not going to associate that, and if the credit isn't provided, they will make sure that the smooth functioning of the business operation will take place. The business firms extend credit also because of custom that has been built up over the time. So credit, providing the credit facility, providing the time duration for the further payment of money, that is a system which has been created over the period of time in the Indian subcontinent on the Indian market. Trade credit is not cash loan, but it's a result from the credit sale of goods slash services which has been paid at the future date after the sale takes place. So here trade credit is not any cash loan which is being taken from the institutions or from the manufacturer, wholesaler, or other person, but it is a time duration which has been given from one party to another so that they can make the payment at the future date. In other words, when the goods are being delivered by the supplier to the customer and the payment is made after some time, it is known as a trade credit. In distributive trade, these kinds of credit has great significance, that is the most important part of any business transaction. The small retailer to the large extent rely on obtaining the trade credit from the supplier. So retailer will have the reliability that the supplier will give me the large amount of credit so that I could easily able to get the goods and sold out that goods to the ultimate consumer in the market, and can have the enough time remaining from me so that I could make the payment to the ultimate supplier. It is an easy kind of credit which can be obtained without signing any debt instrument, without having any kind of an agreement. A mutual trust has been built up. It is a kind of a rules or policies are there in the business, and accordingly the credit has been provided. The ideal time which the credit has been given is for the 30 days, sometime it is for the 15 days, sometime 45 days, and the maximum time duration at which the credit can be provided to the third party, that is of 90 days, that is 3 months. It is a readily available and is a cheap method of financing. The suppliers sell the goods and willingly allow 30 days or more. So if the supplier is supplying the good, he willingly give 30 days for credit. But if the person who have got the goods, if he wanted to have the more amount of days credit period, then he have to make sure that the credit period can be extended from 30 days to 45 days, or we can say 60 days or 90 days, somewhere like that. They even offer the discount if the bills are cleared within a short period of time, such as a 10 days or 15 days. So these terms are known as a trade credit, and it is not rigid in nature. Trade credit is flexible in nature. It is need to be understood by the supplier and the manufacturer. Again, a new bill is being prepared, and accordingly the credit period can be extended from a specific time to the another specific time. So these are the concept of trade credit. I hope that you all are very much clear about the two concept, that is the financial institutions and the second one is a trade credit. The things that is given to us is distinction between shares and debentures. The distinction has been given between the shares and debentures. Distinction has been given between the equity share and the preference shares. Distinction has been given between the owned capital and the borrowed capital. So your homework is you have to complete the distinction between the owned capital and the borrowed capital, equity shares and debenture, equity shares and the preference shares. Thank you.